So we're going to have some fun today because, of course, we have a serious note in this webinar as well, but it's also in a way meant as a bit of fun, right? That's why we said 25 mistakes. So, but there's a serious side to it because many of these mistakes are unfortunately because of the performance of trading not being optimal or maybe even being poor. So we're going to take a look at 25 of them, in fact, and we started out with 20, but we added a few. So the risk disclaimer, as always, trading for exchange and global financial markets is considered high risk and may not be suitable for all investors. Please seek the advice of an independent financial advisor for more information on that. And yeah, this webinar is for educational purposes only. So thanks for your attention on that. Alrighty, so once again, host of Admiral Markets. My name is Chris, and Tarantula has joined us today as well. And he's going to start off actually with the first 11 or so in just a second. But we just wanted to mention how great Admiral Markets is with these great spreads. If you haven't looked at it already, here's a screenshot of a typical spread on the euro dollar and other currency pairs, as you can see. So today's goal, well, we're going to take a look at the a list of 25, not 20. What are those mistakes, in fact, and why are they mistakes? What can you do to avoid them? And at the very end, we're going to ask you what you think is the biggest mistake. So that would be an interesting contest. It would be appreciated if you voted. We're very curious what you think, and maybe you missed a mistake in this list and you want to add it. So now we're going to start with the list, in fact. And Tarantula is going to...
Yeah, guys. Yeah, here I am. So there are many mistakes which many of Forex traders make basically all over the course of their career. So the thing is that you should always concentrate to avoid those mistakes. And by knowing your mistakes, you will minimize your losses. And that also includes your trading plan. So avoiding mistakes is the part of your trading plan. That should be always a part of you, not just the trading plan, but it should be a part of yourself, of your subconsciousness, of your vision, of your future self. The thing is that one of mistakes that are very common in Forex trading is that measuring success is done only in reward, not in plain implementation. And that is very nasty thing, because if you only want to have rewards, that means if you aim for pips or you aim for a certain profit, that is bad thing. The real success is not only making profits, it's about following the plan. Why am I saying that? Because it's eventually you can be good for 1, 2, 3 months, but eventually, if you don't follow your plan, the market will turn against you, and will 100 and 150% for sure. If you have the plan, that means that you are included of sightings that are trading. It's not all about profits. Remember remember the first webinar that me and held together. It was basically the first thing you need to do is protect your equity. That is the very first thing. And the second thing is to make profits. So the first thing you should be concentrated in is to safeguard your equity. And the second thing is to make profits. If your plan is vice versa, to reward yourself only with making pips and profits, your account will eventually be burned, because the market doesn't care for your profits. All the market care is basically what it has in its own mind, and we don't know that. We only try to follow the market. So plan implementation, it will lead to potential plan B if a plan A fails. Plan B, maybe if I lose 3% in one day, I will stop trading for that day. If I lose 5% in a single day, I need to be very, very steady in my decision not to trade a day, even if I see a potential setup. So I call that sneak attacks, and that is very true, and you know that it can happen. For example, I have read many analyses. Let's say today I have read many analyses, because I think I was the only guy who thought that euro will come to test 35.40 and 35.50 level. That was my plan. My plan was to buy the dips. My plan was to buy the dips towards 35 or 34, 85, 80, 90, whatever. But the thing is that all of the traders who I spoke to yesterday and which plans I read today were almost sure that euro dollar will drop to test 34.20. And my plan A was to long into support and to see if my trade will come. My plan A was also to short around 35.40. And my plan B was to cut the losses short if it fails to happen. So if it goes through 34.80, I was thinking about shorting it, but only then, and only then. And my plan A worked fine, but what if my plan A didn't work fine? Then I needed to switch to my plan B. So by planning, you always will have your full attention to your goals, and your attention will be focused on yourself, not just the market. So the plan is your shield. It will shield you from very bad mistakes, such as losing 20 or 30% in a single trade. Next mistake is, well, I know that many of you do that, but I know that some of novice traders didn't listen to me last time when I was talking about it, and unfortunately they lost the money. But it was their mistake, and it has everything with psychology. Demo trading is necessity. If you want to have some success in Forex trading, you need to demo trade or paper trade, because we live in era of internet, and we don't do paper trading. It was done some 25 years ago. There was no internet and such things. But today we have good tools at our disposal. Those tools include fully functional demo trading platform. And by choosing, of course, Admiral Markets as your favorite broker choice, you will get a fantastic demo support. And the first thing I wanted to do when I started to trade is to demo trade, because I was thinking, I know that there were many strategies over the internet, but what strategy suits me? I didn't know that. And when I started to demo trade, I picked the strategy. I picked 5 strategies and I practiced it. But how I practiced? I didn't practice it like it was demo account, because you know when you trade demo account, usually you don't get involved with your psychology, because it's easier to trade demo. You know that you can have a million or a billion virtual dollars or euros at your disposal, so you usually won't trade it fully to fully how you would trade a live account. But I pretended that my demo account is my live account, and I really was happy when I made profits. And I was thinking, well, if I know how to do that on demo account, why wouldn't I do that on live account? And basically it was the same thing. It was the same thing. Doing demo trading and doing live trading, it was almost the same thing, because I pretended to trade live account. I was unhappy with my losing trades. You know, I was getting nervous when I lose. Of course, that isn't the very same psychology when you trade demo live. but at least it will give you the feeling how you would trade live. So you shouldn't trade demo account too long, because eventually you will lose the feeling for live account. But 6 to 8 months is optimal with proper plan and money management. And that is my advice to you. If you don't know how to trade, if you haven't picked your strategy yet, try to practice one, and I mean it, one strategy. Pick the good trading system or strategy, find the proper mentor for that strategy, and practice it. Don't search for Holy Grail. Holy Grail is yourself. It doesn't exist in the form of a system or a strategy. Every strategy, every system works fine as long as you keep your money management, the risk management to normal boundaries. So don't search for Holy Grail and stick to your trading strategy. I really mean it. Stick to the single strategy you have, or at least use 2 strategies. Counter trend, I say, and trend strategy. And then practice it on demo account, and when you are profitable, switch to live account. Screening time is also very important. If you demo trade, you also need to have screening time. Why am I saying that? Because screening time will give you that gut feeling, and you will learn more of price action subconsciously. That subconscious level of knowing price action will give you that inner feeling to stop your trade or eventually to reverse the trade. So it will raise the chances of spotting good exit and reversal point. But yet again, believe in your strategy. Don't just blindly follow your gut feeling, because many times your feeling can be very wrong, right? But also it will teach you when not to trade. If you don't have enough screening time, you won't get familiar with price action. You need to have a feeling, even if that price action is a thing for itself, it's a creature for itself, you still need to get familiar with it. It will bite you from time to time, but at least it won't chew you, it won't eat you. So you need to have a screening time, because you will get feeling for price action. Demo trading without a screening time is waste of potential money. So if you demo trade, always pay attention to price action. At least pay attention at hourly close of the hour. Let's say the top of the hours, TOTH. At least pay attention to 1 hour time frame, top of the hour, so you will know what is happening. You don't need to stare at 1 minute chart, but you need to have at least a couple of hours of screening time per day for full 6 to 8 months. Nice comments. I'm scared of being that. Well, you shouldn't be scared if you go with proper risk management and money management. Because even if the price action indeed bites you, it won't be the big portion of your flesh, hypothetically speaking, because your risk is low. So if you go I'm always saying that if you go with 30 pip stop loss, use lower leverage. Use triple or double, cut in half your leverage. So don't go with full leverage. It's always about risk management. Yet again, next mistake, no evaluations of trading or trades. So how would you know where you made mistake if not doing post-trade analysis? I always, when I make a trading mistake, at least sometimes, of course, we all make mistakes. But if I make mistake, I will analyze my trade. I will look why did I make mistake. By time I have developed a feeling for price action. So even if that will be one of next mistakes, I will explain also. But even if I see the mistake, I can always stop my trade and enter the second trade, because you know, I need always to have a fundamental understanding of my trading position, because not each pair is suitable for trading each day. You need to find trending pairs. So if you have a good trending pair, you will be spared of ranging market. Ranging market is market where we usually lose the money. So if we go with breakout trades in the ranging market, we will eventually lose. So how we protect ourselves from those mistakes? By going with trending pairs. You open, for example, 4-hour or daily time frame, and then go with multiple time frame analysis. So you will have a better view of the market. And if you make mistake, then analyze it. Why did it happen? Your system is probably good, or your trading strategy, but you know the market. Market doesn't follow you or your system. It follows only itself. So you just try to filter those mistakes by doing a proper analysis after those mistakes happen, and try not to repeat them. So if you long at a very resistance on a ranging day, be sure not to do that again, because surely next time it will bite your account again. The very next mistake I'm gonna tell you about is, this is very important, not closing a trade by error immediately. So if you have made an error or misjudgment of a trade, close it immediately, especially if the trade is leveraged. That happened also to me today. I had a very nice long around 35. I closed my long for 30 pips of profit, and then what happened basically is I saw that 35.09 is daily pivot point, and I thought that if daily pivot point is broken, the price will eventually fail maybe to test 34.90 again, so I can long it again. And what happened is I opened a trade immediately after the break of daily pivot point, hoping for a nice breakout trade. But what happened is the price reversed at 35.04 and then closed again above 35.15, right? 35.15. And I didn't want to place my stop loss. I closed the trade immediately because I knew that was a bad trade by candle configuration, but by hourly close, by watching a price action on lower time frames. I saw that that kind of trade will surely bring my stop loss to execution if I let it run. Of course, I would use around 20 pips stop loss, but I closed it with 10 pips of a loss, and then I longed immediately after I closed my trade, because I noticed that that market, euro dollar, will go up again. I saw that it was being rejected. I saw a realignment trade around 35.15. I saw 1 hour hammer above 35.15, so I closed my short trade and I immediately reversed to a long position, and I closed it for some 20 pips of profit again later. So basically, this is very important. If you have made an error or misjudgment of a trade, close it immediately, especially if leverage. Praying that the price comes back is something you should avoid. And that many traders do that. They open a trade, they don't use stop loss, and then basically what happens is, well, they pray for the price to come down. But what if it doesn't come down? Well, you know what will happen. You will lose. You will eventually, it will go so against you, so much against you, that you will be afraid to close the position, and you will eventually leave the position. You know, that is, unfortunately, I know a trader who did that, and that was the mistake of his life. Not closing a trade if you see that the trade is going to be very bad is the very, very big mistake. It can end with, if you're lucky enough, break-even trade or some profit, but normally it will end up with loss, and it will end up with a huge loss. And
that can be sometimes quite disastrous indeed. I know example of a trader that hedged, or started to hedge in fact the big position, but that actually the hedge turned into a bigger hedge and even bigger, and the gap just started to grow even more. So it became a real monster indeed, the entire trade. And when you see something like that, you're just happy to avoid these things, because those are really horrible, terrible stuff. So
yeah, Chris,
focus on avoiding that. Indeed. Yeah.
It's very, very. Do these traders carry on after a big loss? I don't know. This trader, which I know, have never traded anymore because he lost 20K in couple of days. You know what the problem is? The problem is 300 euros. It's not much if you have a big account. But imagine a trader who had 20K account and he lost 70–80% of his account in a couple of days. You know what the problem is? The problem is that if you open a trade, your first trade of the day should be with very low leverage. Let's say on 10K account, go with 0.5, 0.3, 0.6 at best, and then go with that. That will give you a potential second or a third chance. But if you open a trade with one or two lots on 10K account, and that is your first trade of the day, and if you lose it, you will never have a good chance to recover in that day. So my advice is that your first trade of the day should be with lower leverage, and each day go like that. And if you're wrong, usually your second or third trade should be winner, right? So then you can raise your leverage a bit just to allow that the market gives you that second chance. So don't go with much of leverage for that very first trade of the day. Well, guys, you know, trader is telling me I had the same mistake, lost 300 euros. If you have $1,000 or euros account, well, 300 euros is 30%. That means that you were a lot over leveraged. That means that you were over leveraged. But if you lose 5% in a single day, well, you know, it's not much. Can you start without leverage? Well, if you have a 100K account, you can start without leverage. 100K is $100,000. Then you can go without leverage. But usually if you go with 1,000 or 10,000 or more, we use the leverage. But it can be used to your advantage. Without leverage, you know, on small accounts, we cannot trade because we wouldn't earn anything. Leverage is a good thing. Don't be afraid. But you need to know the proper leverage size. That is why I'm saying usually on 10K account, $10,000 or euros account, 0.5 is very good. 0.5 is excellent. If you use 40 pips stop loss, then go with 0.3, because it won't be so stressful to you. But if your first trade is one full lot and your stop loss is 30 pips, if you lose it, you will lose 3% in a single trade, and that will not give you a proper chance to recuperate yourself, because you have already lost 3%. But if you go with 0.5 and you lose those 30%, it will be only 1.5% of your account. So you will have another chance to recuperate yourself. Or if you go with 0.3, you will have 3 chances for 3 substantial bad trades to lose that 3%. So, you know, the problem is that the guys just don't know how to use the leverage. You can go with a happy trade, for example, opening 5 lots on 10K account, and if that trade goes good, you will earn 20 pips is $1,000. But it won't happen every time. Eventually you will lose, and you will lose a lot. Imagine what is 5 full lots on 10K account with 30 pips stop loss. It's 15%. 15% in a single trade. Are women better traders? I don't know that. I don't know many women traders, to be honest. Okay, let's go with next trading mistake. Next trading mistake is very early close of profitable position. I always say cut a loss short, let the profits run. But the thing is, this is a mistake which we usually do, but we are not guilty just by ourselves. This is very hard to say that this mistake is just our mistake, because the market is a nasty thing, and the thing is, I can agree that early close of profitable position is a bad thing. But also, if you scalp, that is not a bad thing. Why I'm saying this, maybe some of you will confuse it, but if you go with a positional trade, that means that you open a trade with 30 pip stop loss and you go, for example, with 40, 50 pip stop loss. If you do that, if you close that trade after 10 pips of profit, then that's bad trade, because you closed your potential profitable position with a very poor risk to reward. But if you go with scalp trade, that means that you will eventually have a 15 pip stop loss, right? And if you close it for 7, 10 pips of profit, it's good, because scalping trades are very hard to achieve 1 to 2 risk to reward. Scalping trades are usually trades which yield more risk than reward. So there is discussable thing. If you scalp, well, it's up to you. If you close your profitable position on an intraday or intra-week trade, then that's a bad thing. If you go with daily trading, trading on daily charts, 30 pips with 30 pips of profit with 100 pips stop loss is bad trade. But 200 pips with 100 pips stop loss is a good trade. So it's up to you. It's up for your trading style. I just want to say that scalping does not fall into this category. Scalping is 80% of the time bad risk to reward. The only thing which does better things to you when scalping is that scalping strategies can yield a better range of success than failure. Let's say that average scalping system will give you 60% of success in trades. A good scalping system will give you eventually 70% of success. But risk is bigger, because you will take 15 point stop losses in order to achieve 7 or 10 points of profits. So you need to choose whether you want to have more success in your trading, or to be more risk to reward, to have more risk to reward potential. And I know that most of you, and well, most of us, when we scalp, we choose the first thing to have more success, but with more risk. Well, that's the way of scalping. But for intraday positions, don't guys, if you trade one single trade in a day, try to make at least 1 to 1.5 or 1.2 risk to reward. I know that sometimes it's hard. You will have many break-even trades, But well, sometimes you just need to do that, right? And also, the only exception is a losing trade that came to a break even. That is the only exception to this rule. What does it mean, translated to Forex trading? If you have opened, for example, you open your position and immediately it goes against you. Your stop loss is 20 pips and it goes 18 pips in a loss. And then eventually it comes to break even. Okay, close the trade. It's okay. It's a normal thing. Don't wait for profit, because probably the price is going to retest your level and go again against you, but next time that will be a losing trade. So if you see that your position is almost hit your stop loss and it reversed to break even, to close it. That's the only exception. And let's answer questions a little bit later. Let the losers cut the profit short. This is also a big mistake. And we again come back to that risk management. This is one of most common mistakes in Forex market. Many traders just don't use stop loss and wait for the price to eventually turn. I also noticed some threads on Forex Factory website, and I just need to say, I use this occasion to say that Forex Factory has become one of 1,000 websites which are currently have the highest rank on all websites in the world. Forex Factory has entered in the first 1,000 websites all over the world. That is a big success to Forex Factory, and I had a private message from Forex Factory administrator saying thanks for your support. You know, I'm a very big fan of Forex Factory. I've been posting there for 3 years, have my own thread running there. You probably know all of that, but the only thing which bothers me is that I also read that there are many nonsense threads on Forex Factory saying that stop loss should never be implemented. Stop loss is a bad thing. You know what bad thing is? The bad thing is dying the death of 1,000 cuts. That means that if you use too tight stop loss and your stop loss gets hit 5 or 6 times in a row, your account will eventually be dead by 1,000 cuts. So that is if you use your stop loss with very little margin. So stop loss is absolute necessity. You always need to use your stop loss, but you just need to know where to put that stop loss. It's all about that. Praying to the God is if the leverage is too big. That happens to most of new traders. If you open a position and your position goes against you, you will get anxious, you will get nervous, especially if that position is highly leveraged. And then you will start to sweat, you will start to stare at your screen, and you will pray to the God that price reverse and that will never happen again. Well, you just know that it will happen, right? You know that it will happen, but if you take this webinar very seriously, you won't let it happen again, because you will know that it's up to you. It's not up to market. It's up to your psychology. Mistaken or bad trade, which can be the losing trade, should be closed not by a stop loss, but with equity management. That means if your losing trade is gone very bad against you, you're losing at least for, let's say, 20% of your account in a single trade. Don't wait to lose 50 or 60%. Close it. That's called equity management. We are not talking now about trade management. Now this is a much serious thing called equity management. If your equity management goes wrong, your account will be burnt. And that is the worst thing it can happen to you. Well, there is one Worst thing from that, I will say that at the very end. You will all probably know what the biggest mistake in Forex trading is. But if you, let's just stick to this. If you don't cut your losers and your equity management is getting in danger zone, you will lose your account. Don't ever lose more than 10% in a single trade, especially if the trade is not traded as intra-week trade. That means that you are holding your position for, let's say, for a day, and you lose 10% for just a single trade. Stop trading for that day or that week. Next thing is trading illiquid pairs. Don't trade the pairs you are not accustomed with. Also, I need to stress one thing. Very good currency pair is, well, not always, but for trading has been euro-dollar. Euro-dollar has been accounted for 28% of daily global volume. It was the recent Bank for International Settlements survey of currency market activity. Why is that so? Because euro-dollar receives further interest from volume generated by euro crosses. I'm not talking now about dollar crosses. It's euro crosses, euro pound, euro Swiss, euro Japanese yen. And this interest tends to be contrary to the underlying US dollar direction. So, euro dollar is good because if dollar index goes up, euro will go down and euro dollar will go down. And now we need to know what illiquid pairs are. Illiquid pairs are, well, for the last couple of months, it's euro Swissy, especially last year because it's pegged currency, and I never trade it. Since it's become pegged, I don't take a look at it. There were times when I traded that currency pair, euro Swissy, but since it's become pegged, well, I don't have any interest to trade it. Also, dollar Swissy is very illiquid because the volatility and illiquidity of Swissy suggests you that you need to use a more proactive overall approach to trading those pairs, particularly concerning above-mentioned risk management. And that means position size in relation to stop levels. So, dollar Swissy mostly trades based on overall US dollar sentiment, as opposed to Swissy-based economic fundamentals. So, my advice is don't use it, especially USD, Norwegian crown, and those crosses that are never popular and that have big spreads. If the pair has big spreads, it means that it's a liquid pair, it isn't traded too much, and you should avoid it. If you trade by margin, using very big lots compared to your account will usually be a bad thing to your account. It's called gambling, and that is putting all money in a single trade. So 10% of the account, I mean by trade, 10% of the account. If your account is $10,000 and your trade goes with $1,000 loss, close it. Don't wait for price to go further. Don't wait for price to retrace. Just close it. So 10% of the account. I don't talk about trade margin. I just talk about 10% of the overall account. That's equity management. You need to protect it because you need money to trade. No matter how sure you are about a trade, it may go wrong. So putting all money in a single trade is a very bad thing because it's equal to gambling. So you gamble to that position and you're not sure whether it will go up and down and it will hit your price or not. So that is a very, very bad thing. And the next thing is falling for Forex scams. This is also important to read that. Forex market is full of scams. $97 systems that are sold over the internet simply cannot make you money. That is the truth. I tested it. I tested it on many demo accounts, and none of them makes money. Many of advertising systems with so-called custom indicators are pure snake oil, a developed scheme of marketeer scammers. Beware of marketeer scammers. I'm not allowed to say the names of those scammers, but I know who they are. And I know that they sell the systems for $97, for $40, promising that it will give you billions and millions of dollars. That is simply not the truth. Those are mechanically bad systems which can work for a day or two and then it will eat you. The best thing is go with one-to-one mentorship with approved traders, and don't be sorry for the money you will invest for the right and proper mentorship. One-to-one mentorship with guys who know the business, who use proper risk, proper trading strategies, can give you an edge in trading. Don't go for free systems. Don't go with $97 systems. These all are wrong, and they don't work. They just don't work. Indicators are there to help. Relying too much on indicators, guys. Indicators are there to help. They're not there to just to trade by themselves. So if stochastics gives you a signal to buy it, it doesn't necessarily mean that you should buy the currency pair. Because you shouldn't rely all your trading on indicators. It's a bad thing to do. Because indicators, why? Because they copy price action. So they cannot know what big banks and big money will do. They are useful. They help you, but they are not completely reliable. So do not rely too much on indicator-based systems. There is no good combination. There are good combinations, but there is no mistake proof or a foul proof combination of indicator that will give you 80% success rate. Because that 80% success rate can work, let's say, in trending markets. But if market is ranging, that means that you need to adjust indicator values. But you don't know how to do it, right? Because you are presented with a trend trading system. You have not been presented with counter trend, with range trading system, or with news trading system. So you only trade in trends, and it will give profits. But what if trend changes? Counter trend, you will lose. Ranging market, again, you will lose. News, you will lose it again. So don't rely too much on indicators, or try to learn price action and try to learn indicators that will help you, not rely, just help you. Next is picking tops and bottoms. If you don't have a valid system strategy, don't try to pick tops and bottoms. Market can be very nervous at times, giving you false breaks. That means that if you think that the price will go down around 35.50, it's up to you. It's your thinking. It's not a valid assumption. But if you see that Camarilla is saying that, and that your level, historically drawn level, is saying that probably means that there is 70% of chance that the price will reverse. Camarilla works wonders along with previous big support resistance levels. Camarilla is a great indicator, and Camarilla is indeed an indicator which can help you to determine proper support and resistance levels. Just place Camarilla indicator on today's chart and see it in action. Plain perfect. Picking the wrong level can be disastrous to your account. Why is that so? Because if you pick the wrong level and you keep shorting if euro is in very strong uptrend, you will lose your account in a single day, in a single trade. Shorting 34, price goes to 34.20. Shorting 34.20, price goes to 34.50. Shorting 35.50, 34.50, price goes to 35, 35.50. 300 pips in a single day. But you have shorted it at very, very resistance each time. 2, 3, 5 trades in a row. with all our losses. Goodbye to your account. Use Camarilla and use levels which are previous week support and resistance. Usually the price will magnetically be drawn to those levels. Again, now Chris will tell you next 12 or 13 things. I just want to say, guys, if you take a look, I will be very fast with this. If you take a look at my analysis, I use the red levels and indicating the levels to support resist. Just rely on Rilla. I also use my rest very so that is my trading strategy. Not sure to go with Camarilla. Best of the for trading support and resistance. 10 minutes will go on with that.
Yeah, great stuff, Tarantula. Awesome summary here. And we're going to continue with actually the second part, mistake 12 to 23 or something like that. And then we have the last two that we're going to discuss together. And then we're going to ask you which ones you think are the most important and which ones you think are missing, in fact. So mistake number 12. When a trader is chasing the market, and we can be pretty short about that because we had a webinar, a special webinar directed to that only recently ago. I think it was last week or otherwise 2 weeks ago. Most of these mistakes, in fact, we already had separate webinars so far, and this one was very recent. And basically, it just to recap quickly, trying to trade everything and anything. Anytime a move is there or has been made, a trader regrets that, regrets missing it, and pictures kind of mentally missing the next one. And that's the kind of psychological trap that you're setting up yourself for, because if you start thinking that, then if you see some candle moving, you don't want to mix it, and you jump into a trade. And the pure and only reason sometimes is just the movement of the candle. And that, the candle isn't even closed or anything like that. No analysis, no strategy. Just the fear of missing those pips. That's not good, of course. So that's definitely a mistake in the top 25. Now we've talked about risk, I think, in pretty good detail. So we had a risk management webinar as well, and I think that this is clear, right? Ignoring it is basically gambling, and even if you have some risk management, but you don't properly implement that, either because you're varying your risk too much at too many places without any plan, or you're really not executing your plan correctly, that's also not good. So you're not ignoring it, but you're not implementing it correctly, that's not good either. So let's move on to your trade management. Basically, if you are applying lots of strategies, maybe different time frames, different currencies, it can get a bit messy and mixed up. I mean, if you have a lot of pending orders and you got a lot of open orders and potential things that you need to do at various spots like trail stops, then the whole thing can get messy. I mean, we remember 2 days from now what the swing trade was, and what a week ago your long-term trade exactly entailed. I mean, you might want to write that down to avoid any confusion, and if you are indeed heavily spread through the market. If you have only one strategy and you trade 2 time frames and you have most of the time one trade on, I'm not saying you have to write that necessarily down. I'm sure in that case you can remember it. But for those who really spread themselves a bit more across the board, then that would be definitely handy, because you don't want to make a mistake with trade management. Those are definitely costly mistakes that are easy to avoid, very easy to avoid. Next thing, mistake number 15, not willing to risk. Now, we're talking a lot about risk management and avoiding risks. Well, not avoiding risks in general, but taking proper risk, let me say it this way. And that's very important, but it's also important to know that it is our job to risk, right? It is actually our job. If we would avoid risk, then Forex trading probably wouldn't be the best one, right? Because it is a risky job. It is a job that entails us to take that risk and the willingness to take the risk. Otherwise, if we get nervous of that risk, then maybe we're risking too much, first of all, and it wouldn't help us with trading. Right? We would actually make mistakes because of that, and that's not good. So let's see, what did I write down? I said, yes, avoid mistakes, but risk something and be comfortable with that risk. Basically, when you find a setup that you feel good about or that meets your requirements, then be comfortable with it and execute that plan as if you're executing not your own plan, but a plan of your boss, right? Alrighty. Let's see. Mistake number 16. For those of you who just maybe joined now, we started already an hour ago at the usual time, and I think there was a bit of confusion with regard to maybe the invitation that was sent. It could have been an hour later, maybe. Not 100% sure, but maybe some of you just joined, but we already started an hour ago, unfortunately. It is recorded, though, so that's good. Alrighty. Mistake number 16, not being completely relaxed when trading. Now, I'm not saying, maybe relaxed is a bit exaggerated. I'm not saying that you necessarily have to have a hangmat and drinking a cocktail and a banana shake while looking over the beach. Not that relaxed, not necessarily. I mean, if you trade well like that, by all means, go ahead. But you might want to be avoiding overly tense positions, stressful positions. Check check yourself when you're trading. How do you feel? How's your breathing? How are you sitting? Are you in front of the computer screen with your eyes right in front of it and you're biting your nails and you're sweating? That's absolutely, you're not comfortable. That's, of course, the other exaggeration. You want to be in a comfortable state with not a, I probably made a typo there. It should be ED probably. You want to be in a comfortable state, indeed, where you're focused, but you're relaxed enough to keep the decision-making process going, and you don't freeze, basically, because that sometimes can happen. That you're just like a deer in headlights, right? If you're too nervous, you see that reaction with deers often. You're like, freeze. That's not good. So maybe a tip for that is to create short circuit breakers. You know what I mean? Like if you feel that you're too tense, or if you notice that, like try to develop a regime that would snap you out of that. Stand up. Physically remove yourself a bit from the screen, or have a tennis ball so that you can throw it against the wall or something. I don't know. Something that lightens up and breaks kind of that pattern that maybe brought you into that stressful situation. Alrighty. Mistake number 17, managing reward first, then risk. So I got a suggestion for you relaxing yourself, or snapping yourself out of distress from Lubisha, saying using a taser. Lubisha is very tough on traders, as you can see, including himself. So managing risk, well, we talked about it a lot, but sometimes people get a bit excited about the potential reward. There's an example on the right. Oh wow, look at the downside. This is exactly an example of euro-dollar, in fact, of today. Oh, we hit a bottom, maybe a top here, sorry. We've been reversing here a bit. Look at that space, maybe to test this bottom. Wow, look at that, right? We get very excited, but then once we enter, where do we put our stop loss? That's what we ask ourselves after we entered. That's not the right sequence. We got to know the risk first, and then see if that also lines up with the potential reward. Alrighty, number 18, not having or following your trade plan. We definitely need something on paper that explains to us what our trading plan is. Preferably, you want to have a bit of a more expanded trading plan, and also maybe a short version that you can tell someone, in theory, maybe relatively quickly. So you want a fast version and maybe a longer version with a bit more detail, right? For me, my favorite trading basically is with the trend breakouts after chart pattern, right? Now, the plan is a lot more detailed, obviously. There are all kind of elements included in that I have there. Tips, guidelines, rules. But if I had to say it quickly, that's that, right? So you have a difference between not having a plan, well, then you're not having any rules. I mean, every big company or every company is working on procedures and processes. Many employees are actually involved in streamlining processes and procedures. So imagine a company not having them. We are also companies, own companies, self-employed. We should have those rules as well. And not following those is in fact being a bad employee. And if you don't follow a rule, you can sit down with yourself and talk to yourself and say, Chris, why did you not follow the plan? You can maybe give say something to yourself and say, boss, I'm sorry, this was the reason. Of course, this is a bit difficult to have this conversation, but basically, this is our situation if you're trading as a retail trader and not maybe in a trading team within a bank or hedge fund or whatever that have these tasks diversified and split to a certain degree at least. Mistake 18A, and this is just more for the fun, forgetting to delete a pending order because it has happened to me. It's stupid. You have a trade idea, it doesn't pan out, and you kind of just like, the trade didn't work out. Forget it. You walk away, but you forget to delete that order, and that can have stupid losses, or maybe sometimes a win, but usually you want to not forget that, and it's just a stupid example that happened to me, and it's a stupid mistake. Alrighty, we're getting close to the end right now. Mistake number 19, when Forex trading gives you an adrenaline. Not good. That's also connected to the stress level. If Forex trading is interesting for you, that's fantastic because you need that interest to keep you motivated, to keep that drive in order to succeed because it is a marathon. This is not a sprint. If you I read somewhere on LinkedIn that someone was saying, I got plus 10% and I started 3 weeks ago. And please contact me here. Well, 10% is a great result. But before maybe doing something like that, you would want to have a bit more track record. Let me say it this way. Because this is not about a day or two. It's really it's a long-term thing. You want to set yourself up with a bit of a marathon mentality and not declare yourself the winner after maybe finishing 200 meters out of that 40 kilometers, right? So anyhow, I'm diverting. Interest in Forex trading is very important, but if you get too much of a risk seeker thrill kind of, if you have the same adrenaline that you have when you're skydiving, then maybe you're definitely using it too much it's too much adrenaline. It wouldn't help your results. Now everyone is going to go through that period a bit at the beginning because it is exciting, or usually it is exciting for the most who start out. If it isn't a bit exciting actually at the beginning, then maybe interest levels too low, Maybe. Depends from person to person. It's difficult to say. But in any case, you have to balance it out. So you have to realize that. If you realize that, then you can at least try to decrease that. It's difficult to decrease it. It just most of the time requires screening time and looking at the trades and taking trades, and then really usually the losses eventually kick down that excitement in a way, right? So that's often a quick remedy. Mistake number 20, not having a mentor. Tarantula also mentioned that. Check out our educational webinars, for example, or the trading camp. Those are great things. And realize that most of the things you are going through or have gone through, others have passed that stage as well. Mistake number 21, not treating trading as a business. So yeah, it is difficult because we are alone. I talked about it. We can't divide the tasks. Sometimes it would be great if you had the analyst, you had the person who takes the trades maybe, and the other one who does the risk, right? Whatever the division maybe the banks have in their trading desk, we can't have that. But still, doesn't mean we cannot treat our trading as a proper business. That means definitely management of a lot of stuff: money management, risk management, psychology management, etc. Trade management. Righty, mistake number 22, searching for perfection. That is going to cause kind of like a pendulum, back and forth, back and forth. I'll try this. No, I'll go to this. No, I'll go to that. No, I'll go back to that. No, I'll try that. Last time that worked out. I'll do that in fact. This time it didn't work out. You know what? That time 3 weeks ago, that worked pretty good. I'll go back to that. And you're swinging back from idea to idea. That's going to create a lot of disturbances. It's not going to create that proper in-depth knowledge and kind of like the approach. It's not going to be a long-term approach that will get you the results, because it's basically you're not sticking to something and learning enough about one particular method and always bouncing back and forth. And that can happen if you're endlessly testing maybe some parameters that are maybe not even that important and trying to find a perfect optimization. But most likely, if you find a perfect optimization, it's probably just a fluke, and if you would forward test that, in most cases it's not going to work too well. Or if you would test it on a different time frame or data set, the results will be probably disappointing. Yes, you do want to paper trade. Yes, you do want to learn from the past, but there is a certain balance you want to be careful of. I think number 23 we discussed somehow already. I have a feeling. Measuring success only in reward, but not in trading plan execution. Now, of course, if we implement our trading plan correctly, time over time, again and again, and we are not getting results in the long run, well then probably our trading plan is not correct, right? But per definition, we do want to measure success as a trading plan execution, because if we, Tarantula definitely talked about it, if we only measure it in pips, percentages, then we could be setting ourselves up for a kind of a big failure if that short-term success vanishes. Alrighty, I saved this one to the second to last. It's actually something that Tarantula was going to talk about, but it's nicely connected to the last point. And number 24 is choosing an unregulated broker. So one of the biggest mistakes, bucket shops, you want to check out the history and regulations. And if you choose Admiral Markets, you definitely have chosen the right one, right? For example. So definitely be careful with that. And that automatically leads to the last point, and you probably already know it. Maybe someone can guess already. But Mistake number 25, making a drum roll, and this is the moment. What is the biggest mistake out there? I'll pause otherwise, so I'll give you some time to answer. Tarantula, how is your drum roll? Do you have a good drum roll? Do you have a drum there?
I know the answer, so guys, okay, the next 25th mistake, the last one, the biggest mistake. Can someone guess what it is, or maybe someone knows what it is? Come on, guys, well, give us the answers. Unregulated bucket shops. Yeah, you're very close, but there is a thing more.
Yeah, that was number 24.
Yeah, that was the number 24, but 25th is directly connected to 24, but it's the biggest mistake.
Not to trade. Okay, that's not. Do not give up. And
No, guess again.
Those are good ones. They could have been on the list. In fact, I knew that there would be some that would have been, deserved to be on the list. But what can you do? There it is.
Yeah, you got it right. Yeah, you got it right. Herman, or what is the nickname? He gave the right answer. Herman Ignacio. Well done.
Bingo! We have a winner.
Yeah.
Nice job. But the other were good suggestions as well. Do not give up, and trading your emotions. Great idea.
So guys, this was our last mistake, and yeah, indeed. No, I was prior to Admiral Markets. I was with few brokers. I was really unhappy with them, and I was really trying to find a broker of my choice. And when I'm at Admiral Markets, I did the right thing. So the biggest mistake is really indeed not choosing Admiral Markets. Not just why but we are not crazy to give the money to a bucket shop. So if we have our money with Admiral Markets, that means that your money is really, really safeguarded. It's very sure, and it's a regulated broker, and it's very, very good thing to have a nicely regulated broker. I have traded with a lot of firms, a lot of investment firms, and when I traded with hedge funds and investment firms, I did only with regulated brokers. But believe me, guys, even those regulated brokers didn't have so good spreads and so instant execution. So the right thing is really AM, and I mean it really.
Absolutely, absolutely. There's no better deal out there. So the choice is already made for you. No, just kidding. I mean, but it is a very good choice if you make that choice. And now I guess we're quite over the time already, but still, what do you think is the biggest mistake? And do you have any suggestions yourself? Just a minute or two, if you have something that pops in your mind. I'm just curious, because Tarantula and I were talking about this list together earlier this week, making it 25, top 25. Well, actually, the goal is top 20, but. So what do you think is the biggest one? If you had to choose one of them, we're just curious. And do you think that there's something on the list that should have been there? Or you really think that that should have been part of the top 25? There's something that crosses my mind that maybe we didn't pay attention to. Having a plan, I think that one we covered. Oh, that's the most important, you think. Okay, understand. So having a plan, Libusha thinks having a plan is the most, not having a plan probably the biggest mistake, right? not using stop loss, money management, not investing in education, very good. And you certainly all are by visiting these webinars, because as Michael also says, you could spend that time watching funny cats, but you instead look at this webinar. So great job. Give yourself to emotions is another one. Another mistake is maybe trading after disastrous losses. Darshan is saying, I think. Yes, trading after maybe a bigger loss than usual, or maybe even after reaching your daily max, for example, who knows. That's a good one, absolutely. Not having a plan is Pavel's suggestion. Yeah, definitely. You definitely want to have some limits and checks and controls, at certain points. Depends on how you trade. During the day, during the week, whatever. Changing your winning strategy. And Modres maybe has the best conclusion of it all, and is saying all are important. It's like a big puzzle, which is definitely true, because they're all, in fact, it's a balance, isn't it? You could do 24 of these 25 things excellently, but if one fails, that could indeed be a big headache already. So I guess that wraps it up for today. There's just a question regarding the email of Michael. Let me see. Not so sure, in fact, the email. Let me write Michael a chat. Can you send me an email? I think you send me, oh, thank you. Someone has it there, in fact. Kaylin, do you see that email address? I don't know if you can see each other's chat, in fact. Do you see each other's chat? Or only your own? You cannot see the other people writing there? Okay. Let me then write it for you. It's mo@admiralmarkets.com. Alrighty. Biggest mistake is no having rules and poor money management and trading without a plan. Definitely. Definitely so. That wraps it up for, I guess, for today, and we'll be back next week with Tarantula, I think on Monday and on Wednesday, but we'll have also Tuesday, Wednesday, Thursdays, the live trading room. So I wish everyone a great trading tomorrow if you trade, and otherwise a great weekend as well.
Yeah, thank you for attending our webinar, and we wish you all green pips. Thank you for staying with us. Talk to you soon, guys. Goodbye and good luck with trading.